With this chapter, we turn a corner in the course and we start to talk more specifically about business decision making and how economics impacts businesses. So if you're a manager of a fast food restaurant, say McDonald's, what operation decisions do you need to make? You got to decide things about labor, right? You got to decide how many workers you need, how many you need per shift, who's going to work how many hours, those sorts of questions. You also have to decide things about capital. Now, capital is the word we use to describe any machines that are used to produce your output, right? So, products used to produce other products. So your capital would be your cash registers, your grill, your fryer, all the things, your building, your tables, all the things you use in your production process that are themselves products. And you've also got to make decisions about other inputs. So like how many hamburger buns do you need to buy? How much ketchup do you need? Those types of things. In all of these decisions, what is your goal? If you're a business manager, if you're running a McDonald's or any other business, your goal is profit. Not just profit, but as much profit as possible. Your goal is to maximize profit. What is profit? Now, profit is the difference between your revenue and your costs. So your revenue is the amount of money that comes toward you, comes to you, the amount a firm receives from the sale of goods and services. We've talked about this in previous chapters, and we've defined it as price times quantity. How many did you sell and what did you sell them for, right? And then your costs, of course, are the money that you spend, the amount that the firm spends in order to produce and sell those goods. Your profit, then, is your total revenue minus your total cost. And in parentheses here we have or loss. When does the firm earn a loss? It's whenever the costs are higher than revenues, right? So you calculate your profit as revenue minus cost, and if that's a negative number, it means you actually have losses, not positive profits. As long as that's a positive number, you've earned a profit. Now, the revenue side we've already touched on, price times quantity. Let's look a little more deeply at the cost side of business. So when it comes to costs, there are two types of costs. There are explicit costs and there are implicit costs. So explicit costs are the tangible, out-of-pocket expenses. They're the more obvious costs. These are the bills that you pay. At the end of the month, you cut a check for them, right? So things like wages that you pay to your employees, food costs, utilities, those things that you write a check for, the things that you pay out of your pocket, the obvious costs, right? Implicit costs are less obvious. Implicit costs are the opportunity costs of doing business. The opportunity cost of your capital, the opportunity cost of your time. So remember, opportunity cost is the value of the next best thing you could have done. So when you choose to become a manager at McDonald's, you may be giving up your wages as an employee at Burger King, right? What is that opportunity cost? What did you give up in order to open your own McDonald's, right? In your capital, how much did you give up in order to invest your money in purchasing a new grill for your burgers? You could have put that money into the stock market and earned something else on it, right? What did you lose? What did you give up when you chose to invest that money in capital instead? And time is sort of more of an obvious one. When you chose to work for McDonald's, when you put all your time into opening your own McDonald's, what else could you have done with that time? So explicit costs are your electricity bill, your advertising, your employee wages, those things that are just sort of the obvious costs of doing business. And implicit costs are described on the right-hand side here. The labor of the owner, if you work for the company but don't draw a salary, all that time that you put in. the capital you invested in your business instead of investing somewhere else. The use of your stuff. You use your own car to do things for your business and maybe don't pay yourself back for those things. Your computer, other personal equipment to conduct business. Those are all opportunity costs. Those are all things you could have chosen differently, and you gave something up in order to choose to do this particular economic activity. So if you were in an accounting class and you discussed profit, you would define profit as just the revenues minus the explicit costs, revenues minus expenses. How much money did you bring in and how much did you write out in checks, right? That's accounting profit. Economists, however, when we consider profit, we consider all of those costs. So economic profit is your revenue minus explicit and implicit costs. Or in other words, it's the accounting profit minus implicit costs or opportunity costs. And so economic profit is always going to be less than accounting profit, because we're going to take that accounting profit and then we're going to subtract out some other costs. So that's an interesting thing to keep in mind as we go forward here in this econ class when we talk about profit. Keep in mind that that's not the same thing as an accounting profit. You could be totally above the zero line when it comes to your discussions with your accountant, but an economist may say, sure, your business made money, but you could have done better if you had chosen instead to stay at Burger King, right? So the economic profit is always going to be less than the accounting profit. And the fact that you have a low economic profit doesn't always mean that you are not making money in an accounting sense. So this is just to give you some perspective of what those opportunity costs could be, opportunity costs of capital, the money that you invest in a new building for your new McDonald's, in your new equipment, your new tables. Certainly the goal will be that you buy those things so that you make that money back by having customers, right? But the opportunity cost of all that money is what you could have earned if you'd invested that money somewhere else, right? So historical averages, stocks get a rate of return of 8%, bonds of 3%, some savings account of around 2%. So these are things to keep in mind as what you're giving up when you choose to put your money somewhere other than in the stock market. So here's a little example of calculating profits, right? So say you're a McDonald's and your revenues for this time period are $8,000 and you have 3 lines of explicit costs: your workers' wages, your insurance and rent, and your food ingredients. And when you do the math there, you take your revenues, 8,000, and you subtract out all of these expenses, and your accountant would say, cool, you did great. You ended up $500 in the black. Your business made money this time period. But then, if you think further about, okay, cool, my business made money, but how much could I have made if I had done something else? The opportunity cost of your time, you could have made $300 somewhere else with that time. The opportunity cost of your capital, if you had invested it instead in the stock market, you could have made $400. And so if you subtract those out of your revenues, the economist would tell you your economic profit is actually negative $200. You could have made $200 more if you had made a different choice, if you had instead, say, stayed at Burger King instead of opening your own McDonald's. So this is just a brief overview of, first, what is profit? What is the business goal? It's to earn profit, right? And we've already talked a good bit about revenues. This is some on the cost side.